right, good afternoon, everybody. My name is Jeff Leppert. I'm our Senior Vice President of Capacity Solutions at Redwood Logistics. And I want to thank everybody for taking time out of their day after Labor Day weekend in the afternoon to participate in this FreightTech series. This one, we're going to focus in on truckload procurement and how to run a procurement event. We've broken it into kind of 5 sections. The first one's we're going to briefly talk about the market conditions. It's important to carve those out, especially this year, to address, is it the right time to host a procurement event? And then we'll walk into why do you want to hold one, the process and rates attached to it. What ultimately is one of the biggest things is going to be the carrier audience and how you onboard them. And then the final stage, which is often overlooked, which is most people just say, I ran one, here's the savings, thanks. And then what they don't realize is that within as little as 2 weeks, everything can change. And so you need to be able to continuously look at your network and make some improvements. Jumping into market conditions, I think here, it's important to carve out kind of the right-hand side. It's a big market, and the left-hand side kind of carves out the scope of the freight revenue market. But on the right-hand side of the slide, there's two key stats that are going to drive some consistent themes throughout this presentation. The first one is that there are a ton of carriers, almost 900,000 carriers. And the barrier to entry to be a carrier right now is incredibly expensive. You have to have a driver or be a driver that's motivated. Trucks are incredibly expensive. Insurance is astronomical. Fuel remains the #1 costing component. Quality of life is a concern. And so major fleets getting bigger and bigger, we don't necessarily have that. We have a lot of small carriers. And so 97% of the total truckload market operates less than 20 trucks. And that's an important statistic to carve out as you go through a procurement, because you want to understand, how do I get carriers to participate in my bid? How do I get carriers to adopt my network and my lanes against something else they're doing? And the other comment I would make is that most carriers are head haul focused. And so when you start a trucking company, it's usually based off of a head haul. It's somebody that consistently giving you freight to leave from one market and go to another market. And that is how traditionally most procurement events have gone, is you've looked at head haul. And it's important to just pay attention to the fact that there's head haul freight is important, and it lays the groundwork for networks. But the triangulation of freight from these smaller fleets it will drive efficiencies to a properly run procurement event. All right, so we take a pause from the market itself and kind of the demographics of the market. Then you want to look at ultimately the index, or a Wall Street look at what the market is doing. And so this is from Morgan Stanley. And what I'd carve out here is the fact that the market reacts to cycles. And so what you'll notice, with the exception of 2017, the last quarter of every year, you'll see that the patterns and the waves are muted. There isn't an incredible amount of volatility. We had a couple of 2 years we had volatility, which was 2014, when we had an incredible amount of snow and a polar vortex. And then ultimately the wave of 2017, which was Hurricane Harvey, which was the first wave you see in purple, and then ultimately the end of the year and the ELD mandate that came in that year. And so that wave started coming. So the market reacts to waves. And so it's good to know when to take freight out to market, but it's also important to note that right now we are not seeing as much the wave anymore, right? We traditionally should have seen a spike like we saw in March with COVID in the deep red line. And we don't see that wave down yet when it comes through September 1st. So we've gone from May 9th through September 1st with no downward wave. We've stayed high. And that's an important carve out to what the market is doing right now. And anytime you see this steady improvement of a line, the next reaction that happens is ultimately rates move. And so you'll start seeing that right now the rates are higher than they've been traditionally, and ultimately higher than they have been in this 9-year average. And they're going to, and ultimately, as it looks right now, they're going to continue to climb for a little bit of time. So I always get asked the question, is now the right time to go to a bid? And I'll speak to it a little bit later. But this is something that we'll kind of carve out as I speak to that. On the next slide here, it's another industry look at what the market is doing. So not only are we at the highest levels in August that we have been since before 2013, we're starting to see a shift in peak season, right? So you can't lose sight of what is traditional in a transportation cycle. And so tradition right now is we're in peak. It's back to school. We're coming in on Christmas and retail and Q4. So right now we have a traditional peak, but if you couple it with COVID, we have an exacerbated problem with capacity. And so carriers are right now are re-imaging their networks. And right now ultimately is another, it's not, again, rates will be a difficult issue, but now is a great time to go to a market. This is the impact of global supply chains. So this is one of the things of the parts of this slide is we have two dynamics. It's peak season and it's COVID. And what you'll see here is that major ports are at a greater than 5.5. And I think I would only comment briefly that the difference between 5 and 7 and 7 and 9 and 11 and 13 is irrelevant. Once you're at a greater than 5.5, it means we have 5 loads for every truck. And because of that, rates are incredibly volatile, capacity is incredibly volatile, and getting freight moved from certain markets is expensive or time consuming. And the difference between 5 and 7 is simply 2. It doesn't necessarily change anything. So we kind of stop the index at 5.5 because of that. The other comment I would make is that anything below 2.5 is considered a balanced or it's not a weak market, but a balanced market, meaning that it's not going to create an incredible amount of volatility as it associates to rates. And so this slide clearly shows that the border states and Mexico continue to feel pressure. The state of California, in particular, Long Beach and Los Angeles, have an incredible amount of pressure, but so does Houston and Charleston and the Eastern Seaboard, with the one exception of being New York and New Jersey, and that has a lot to do with COVID. Moving on to our next slide. This is a great index for industry demand. And there's 3 points that I'll make on this. And again, this does speak to procurement and ultimately the impact of rates. But the blue chart or blue kind of shaded region is ultimately industry demand. And so this is the amount of freight that we have in the market. And a lot of this is on a contracted rate. And what you'll see here in the middle is we had this huge surge for COVID, and subsequently the green line is the rejections, meaning that the waterfall or the volume has exceeded demand and we're starting to see rejections. So what normally is adopted by procured capacity is being rejected. So you want to follow that green line to understand the intricacies of a procurement event. A lot of procurement events, they just assume that once they have a rate and a carrier commits to the capacity, that's going to work. And what we've noticed here is that it's because demand has increased so much that we ultimately, the procurement events of the past are starting to fail quicker. And so we want to be cognizant of what we attack going into 2021. Just a level set real fast, the one yellow line across the middle of the slide indicates basically what we would consider to be a normal, and I use air quotes aggressively on that one, but a normal or moderate supply and volume, demand and volume. So at 10,000 is considered moderate. It's still busy, but it shouldn't create a ton of pressure. And then anything above 10,000, you'll see creates pressure on the supply side of the fence. And I think the yellow line that I put on here in particular for a call out was in March, we had a pre-COVID run up where we had that kind of panic of getting all the store shelves filled with a significant amount of commercial staples. And subsequently, we had a panic of rejections, right? So we had the trucking market kind of soften in February. The spot rates were down. The capacity was handling volume without any problems. And then all of a sudden, the green line spiked. That was because tender volume started. We ultimately lost some of our network carriers. They went home. Then you saw a spike of transactional capacity coming to the market. And then since then, I think the reason why I carved it out is it didn't take us more than 3 months, 3.5 months to be exact, to get back to where we were on a pre-COVID surge. And since then, we've climbed 3,000 points, 3,000 points in this index. And so demand is through the roof right now. And so again, this basically level sets how we would handle a procurement event right now. It's important to do it. And the reason why it's important to do it is because the industry is resetting itself. Trucking companies, they left the market. when the auto industry shut down and they came back and had to figure out what they wanted to do, or they left the hospitality market and have to refigure out what they want to do, or the oil went kind of up and down, and the trucks that were in the oil industry need to figure out what they're going to do. Dry trucks are trying to figure out what they want to do. And so the capacity is kind of re-imaging itself, and we're starting to see that demand is going up, but trucking companies are ultimately not necessarily thirsting, but basically looking for consistency because there's so much volatility that exists right now. This was a good chart for me to call us into, because once I went through the industry supply and demand with the group on the phone today, I wanted to carve out ultimately what happened to the rate per mile. And so if you look at February, the rolling 7-day rate average, this excludes fuel, the rolling 7-day average was about $1.50, right? And we had the Corona surge that hit to about $1.70. That's just strictly off of supply and demand. And then we had a subsequent plummet where we had an incredible softness and only essentials were moving at about $1.30 in the transactional world. And then all of a sudden you've seen a significant increase since then. And this is again, just at rates. But you'll see that the green line was the short term. And that ultimately is somewhere between the yellow and the green is the actual, because this slide was beforehand, but the actual is about 202. And so it's important to carve out the fact that rates continue to go up. And so again, I get asked all the time is when is now the right time to cause a procurement event or go to a procurement event? My answer to everybody is it's always a good time to go to a procurement event. It's always a good time to be looking at your network and talking to your carriers. But right now, it's important to basically kind of mitigate some risk that is clearly presented in the truckload market. All right, this is our last slide as it relates to supply and demand. So I spoke briefly about demand, and now I'll speak about supply and kind of some of the perceptions that we have in the marketplace as it relates. So on the right-hand side, you'll see that we have traditional bid season. We're coming into it, but I want to kind of carve out that the 5-year average, if you look at the volatility that we've had, it's nothing. It's 20 points. And this year alone, we've had 1, 2, 3, 4 different 20-point swings. That to me is something that clearly identifies that this year is unlike any other. So we're coming in on what is the highest market demand index that we've ever seen, and coming into traditional bid season. So while I'm not predicting a perfect storm here, I am predicting the fact that bid season should be intense. And we are, but I think shippers and carriers need to understand that there is a level set that needs to happen and should happen as things start to regulate. And then the left-hand side is again, I think a traditional comment. So when you think procurement event, you think I'm going to fix my rates and will always be this for the next 12 months. And that's the ask, right? That's the ask from executive offices, or that's the ask from supply chain officers, or that's the ask from shareholders. And what I want to show you is that if you drew a straight line on the market demand index on the left-hand side, you'll see that carriers have to price in the volatility that's associated to the market. And so just because it's basically, you think it's a flat line, it's not. And so there's opportunity cost and opportunity loss that they have to weigh in and weigh as a component of their line haul rate. And so we always want the straight line, but in order to establish a straight line or a fixed rate, you have to basically incorporate the volatility of each year. And the only time you saw a flat rate was 2016, that gray line on the bottom. And that was traditionally what we would consider to be a freight recession. It was incredibly soft. But then since then, you see that the volatility has come back, and ultimately the incremental add. So 2017 spent time in the 20s, climbed up to the 30s. 18 spent most of its life in the 30s, climbed up into the 40s, or excuse me, 18 climbed up into the 70s. You see the green line went up, and then 19 even went higher, and spent some time in the 40s consistently. And so in 2020 was shaping up to look eerily similar to 19 until the pandemic hit. And so these are the things that go into establishing the rates from a carrier's point of view. But it's also important to carve out, it's kind of a false reality that if I fix a rate, everything will work. If it fixes a rate, you identify your estimated spend per lane, but it won't actually reflect the actual spend on a given lane, because there's going to be some market specifics that hold true. All right, so once you establish what the market looks like and how you want to once you establish what the market looks like and how you want to, that you're ready to run a procurement event, ultimately what you want to do is decide on what your primary goal is. And I think the biggest thing that I get from everybody is ultimately, I want to reduce my spend, and I want to carve this out and say, it is not about rates. It's important to understand that the rates help ultimately provide a numeric value to what you're spending, but there's a ton of opportunity cost by not looking at your data properly. And there's a ton of opportunity cost by not understanding that your waterfall breaks, or that the market conditions have ultimately degraded to the point where we don't know where they're going, like that we have right now with this pandemic, that it's going to take additional time, money, and resources just to find trucks to move them. And what you want to do with a procurement event is ultimately build that mitigated risk strategy. It's not just about the rate. You need to have a strategy as it relates to carriers and your waterfall, and understand what you're trying to accomplish. That parlays into the next point, which is carrier mix. And this is the point in time where most clients, I would coach them into saying, it's important to find an intermediary. Brokers have a negative perception. Some brokers have a negative perception, and to be fair, some of it's well-deserved. But there are people in this space that are investing millions of dollars into becoming an intermediary that is a logistics service provider and a capacity provider for clients, and not just a broker, which is basically waiting for the Friday afternoon phone call so that they can make some extra money. That's not ultimately, there are people that do that, but it's important to carve out and find reliable providers that can act in the middle, help find those smaller fleets for you, especially in the head haul markets, and help the risk mitigation strategy. And then the last thing you always want to do is you actually want to grade your carriers. So a lot of people grade their carriers and say, great, he had a cheap rate. And then 30 days later, that cheap rate failed them. And so what do you do when that cheap rate fails you is what's next, right? So you need to understand that grading the carriers on something is better than grading them, that's not rate related, is better than grading them on rates. You want to grade them on rates simply once as you set up a routing guide, but that shouldn't be a core competency of what you're trying to accomplish. This is a good chart. I think the key is going to be, once you establish that you're going to take it out to bid and what your goals are, I think it's important to understand the shippers need to understand what's next for them. And so should you outsource this? So once you identify it, and the outsource is big, and I think I want to carve out a couple of things. It's resource related. Do you have the human capital to do this? Do you have the buy-in from your remote facilities or plants? Do you have change management resources? One of the biggest hurdles we come into at Redwood is we offer a carrier strategy and a procurement offering, savings and routing guide, and then take it to somebody only to find out that facility isn't interested, or finds out that facility has a 30-year relationship with an incumbent that we didn't know about, or ultimately doesn't have corporate buy-in. There's something that happens there that the change management is so important. So the numbers only get you half the story. It's important to know that you have the resources and the change management resources. The other thing is going to be, do you have technology? This is an incredibly complex process that requires intense analytics. So if you have technology, then it's a great time to always be running bids. But if you don't, it's an incredible uplift, and it may be worthy of outsourcing. And then the last and probably the most important thing that we'll talk about today is, do you have time, right? A typical good, well-run truckload procurement event will take 12 weeks. It's an entire quarter. And so do you have time to do that? And so if you have time, then it's worth taking the endeavor. If you have resources, time, and technology, it's worth taking the endeavor. But if you don't have resources, time, and technology, it's very easy to outsource this to a number of different people. And the last thing I would, again, reiterate to everybody is, it's not always about rates. So you want to make sure that we have good, clean carrier consistency, and we look past rates. Rates is only the analytical part on the front side. So once we've identified that you're going to keep it in-house or maybe outsource it, you still need to understand a couple of things. Ultimately, where's the market? Is it the right time? Then you walk into, do I want to do this, and what are my goals? And now you walk into, do I know my own data? And so this is the biggest piece that we run into, is that we get data that is not necessarily tried and true and been vetted. It's just whatever the extraction from a TMS is, or it's an aggregated Excel or ERP output. And it's hard for us to basically, or anybody, to drive continuous improvement and effective savings if we can't look at data. And so the two things you want to look at ultimately when you look at data, this is an example of a client that we did, but you want to look at volume by origin, right? I mentioned we buy from a head haul market. It's a traditional model, but it works. And it's not just Redwood that does that. It's most people look at buying at a head haul market. So you want to look at where are you consistently shipping out of. And then you want to look at the summary of your lanes. And so in this given example, we had high origin count, which is great. And then ultimately, and it's not bad if you only have one or two, but a high origin count ultimately affords the ability to basically build mini networks. And then ultimately, the volume range is the most important thing. If you have volume bands that are less than 25, those are traditionally not good for procurement. You're going to end up getting rates that are market-based at the time that you issue the bid. And I can't emphasize this enough. Right now, if you issued a bid for a lane that's going to move once next year in June, you're going to get today's rate, which we clearly showed you a couple slides ago, is significantly higher than what the market may bear in June. And so you probably don't want to take that to bid. But knowing your data is probably the most important thing when you're basically establishing a procurement event. All right, next up is knowing your incumbent carriers. So the numbers on the top aren't necessarily, they're just, again, a snapshot of a bid that we did. They clearly showed that the carrier, this customer was top heavy. And so we had a ton of carriers that were moving free form for one-offs. We were pretty top heavy. And so we wanted to eliminate the top heaviness and spread not necessarily the well out, but ultimately create the risk mitigation strategy attached to it. So being so top heavy was detrimental, and we wanted to make sure that we were shifting their carrier and mitigating their risk. But the biggest point of this slide is actually you want to measure your incumbents. Incumbents are incredibly powerful, and so you want to make sure that it's a different negotiation with an incumbent. It's not, hey, what's your best rate? You need to basically leverage something different with the incumbents. And so you're going to look at service. Do they have drop equipment? Do they have a yard jockey? Do they come in the middle of the night? There's value that carrier is providing you, and you need to be careful of that either A, you provide what they do to the people that are running your bid, or incorporate that into the data if you're hosting the bid. And so that they know that they're buying the same type of service. But it's a false save that's created if we do it the other way. You also want to pay attention to the geography. And so some incumbents basically specialize in just local milk runs. Again, that's something that's special to the incumbent, but you want to make sure that you're weighing and measuring the incumbents properly. Some of them may stink and you need to replace them. It's a different story if that's the case. But for the most part, we've seen that incumbents and change management is the biggest hurdle when we run a procurement event. You also want to pay attention to your broker and asset direct strategy. We'll speak to that throughout this presentation. But again, broker, logistics service providers, digital freight brokers, 3PLs, there's these fancy names for them. They provide an incredible value. They can A, run a procurement event on your behalf, or B, they can they fill that network need of, hey, I have enough volume on a couple lanes, but it doesn't necessarily fit a high volume dense lane, right? So can I aggregate by certain parts, and can I create these little mini networks? Brokers and 3PLs fill that void very well. They also create a risk mitigation strategy, meaning that, hey, it's Friday at noon, the day before Labor Day, and how do I handle the last truckload this past weekend? You need to be able to have somebody that can handle that rate and not exploit the conditions. And then the last thing that I would comment on is when you measure the incumbents is obviously, do they have drop equipment? Another thing that comes up, even if they're a small carrier and it's not a massive asset intense carrier, small carriers may have one or two trailers that are drop and hook and loaded over the weekend, but pay attention to the incumbent knowledge. It's very important as you move forward with who's going to receive your bid and how they're going to rate it. And then once you're done with your data, your incumbent carriers, it's important to present yourself to the carrier community properly. So you want to present who you are. And once you identify who you are, it's basically, what are your financials? What are your, not financials, what is your industry? What are your facility locations? What is the product you're shipping? But you want to present who you are properly to the carrier community. It does make an impact on rates. You also want to pay attention to your freight profiles. And so this is critical for the LTL space. But even important in the truckload space, is it easy? Does it driver assist? Is it easy to load, easy to unload? All too often, shippers choose to neglect this information, and carriers make guesses. And when they make guesses, they raise rates. It's just a hedge, the lever that they pull. You also, the damage to package properly. Are they have claims concerns? Again, another situation where you have the bigger the transparency, the better the rate's going to be. Actually, not the better the rate, the more accurate the rate's going to be. And then overall value. Insurance is incredibly expensive for trucking companies right now. And so we want to make sure that the value of the goods, don't hide it, just disclose it properly. The other thing I would comment on is if we have high insurance requirements, that ultimately is going to change the freight profile on the line haul. And then the right-hand side, this is big. The advent of the ELD in 2017 and subsequent full adoption into 2020, the parking, COVID restrictions that happen at warehouses, meaning that they have COVID and they got to quarantine. They can't take your freight. You got to lay over. Can I park there? Is it easy to get in and out of? Those are the things about the facility that do impact the accuracy of a line haul rate. So you want to make sure that we're disclosing facility information, as many details as we can. Pictures are good. Carriers like seeing and understanding what it is. It will impact your line haul rate. But it's important to know that the facilities are just as important as the freight, especially with the pandemic conditions we're in, as well as government regulations that are in the truckload market. Another comment I would make briefly on the freight profile is ultimately know the difference between what your freight is. Is it inventory build or is it consumption? Is it going to a consumer? Going to production? Is it time sensitive? Is it not time sensitive and it's just basically a transfer from a warehouse or from a factory floor to a warehouse to a DC? Those are important things to disclose because it ultimately changes the way things can be perceived within your network, and not necessarily going to change your carrier rate, but it should change your dependency and how you basically negotiate with the carriers. All right, so once you're done with who you are, you kind of want to walk into the overall procurement strategy. And so on the left-hand side, we've identified a handful of things that you want to standardize. We want to drive to a proper line haul rate. That's the ultimate objective of a procurement event, is what is the most effective and accurate line haul rate for the freight profile that I'm giving to the market. And so from here, you look at accessorials, insurance, fuel, payment terms profile, connectivity, visibility, and contract. And so you want to standardize those things so that you're properly comparing the right things. And then on the right-hand side, you kind of want to walk through 4 big things, and we've spoken to them briefly already, but carrier engagement is going to be, is it incumbent or new? And finding the new guys and getting them to participate and be part of your audience, that's the biggest challenge. And in the outreach and how you're going to get there is going to be, is it in-house? Is it manpower? You know, getting the carriers to basically deliver to a deadline. My bid ends in 2 weeks. My bid ends in 4 weeks, right? Did you get the bid? Did it get caught by a firewall? Do you have the proper information? Was the file too big enough? Just a little blocking and tackling, just getting the carriers the rates. I spoke to it earlier. Some of them only have 10 trucks. It's the wife of the owner that is running the bid. You know, she's got a Yahoo account that you're trying to email to. Those are the little things that are often overlooked. He may have the best rates. It may fit his network perfectly, but do you have the resources to get there? And it's important to make sure that you do. And then demographics. There are an incredible amount of regional players and that are in regions that aren't necessarily your home or head haul market. So Redwood's based in Chicago. We have to have a full, robust carrier Rolodex of carriers in Denver. We have to. Our clients aren't necessarily in Chicago. So as you're looking at your procurement event, you want to make sure that you're looking at the demographics of your freight and the carriers that live and die in that world. There are a lot of carriers that are in the upper New York area that never leave the upper New York area. And if you have freight in those areas, you want to make sure that you're using those carriers that fits their network. You don't want to be soliciting freight from a guy in Chicago or a guy in Pennsylvania that has a truck every once in a while in that area, because his rate's going to skew your analytics. And then the last thing we spoke about earlier is obviously you're going to need to drive performance on the carriers. Don't lose sight of the fact that once your bid's over, you need to be dynamic and understand that you can shift, change, and adopt a new carrier as quickly as possible. All right, now we'll take a deep dive into the rate per mile. I think I've spoken about it enough, and I want to basically carve out a couple of things. And so the first thing on the left-hand side, the gray arrows are things that impact the initial line haul rate. Then ultimately the accessorials and fuel are something that aggregate to spend. They still impact the rate, but they aggregate to your overall spend of a given shipment. But there are four things that we consider to be the biggest things that impact the line haul rate. And so the lane itself is the paramount thing that establishes the line haul rate. Does it fit a trade pair that a carrier finds attractive? Does it fit a trade pair that the industry finds attractive? Everybody here, I think, can agree that a Chicago to Columbus, Ohio is an attractive lane. There's a lot of freight. It's from two populous areas. It's the Rust Belt. There's a ton of things that are good in that region. And something from the Calgary, right, to Minot is not, right? There's not a lot of trade volumes going on in that market. And so you want to make sure that the lane ultimately is the founding principle of a line haul. And again, line haul is what we're trying to drive toward when we run our analytics. The other thing that comes in is that we have got customers that basically want to drag terms out. They say we want to pay in 90 days. That's fine. Right? It's popular right now as everybody's is paying attention to cash. But carriers are paying attention to cash too. And because of that, if you move to 90-day terms, your line haul rate is going to go up. It's okay as long as it's standardized, but the day in the life of basically saying, hey, can I have a rate and then I'm going to pay you in 90 days, carriers are catching on to that and ultimately withdrawing their rates or raising their rates instantly once net terms are addressed. So just know that the most aggressive line haul rate comes with terms that are at or below 30. And the second you stretch them, your line haul rates are going to go up. Consistency is another thing. So carriers can build and adjust line haul rates based off of whether there's one load a week, two loads a week, one load a day. On that lane, they build networks off of that. And they may even invest in new trucks off of that. But the whole point is going to be, if you have 10 one week, it doesn't necessarily mean you're going to get a better rate than a guy that has 2 a week throughout the year, right? Or if you have 100 a month is probably a better example. If you have 100 in 1 month, that doesn't necessarily drive a lower rate. Consistency drives a lower line haul rate. And then insurance. This is a big one. Insurance has skyrocketed for trucking companies in the past couple of years. And so because of that, their line haul rates have gone up. But if shippers put in restrictions about $5 million worth of auto or $2 million worth of auto, it's expensive for carriers to buy that. So I'm not saying don't put it in there, but what I am acknowledging is the fact that if those higher insurance limits are in there, what that does is it limits the ability of carriers that can haul your freight safely and ultimately raises your line haul rate. And then the last two things that ultimately aggregate to your spend are accessorials and fuel. And we'll speak to those on the next slide. So these two are important for a shipper to standardize. And on the right-hand side are accessorials. Again, if you have a facility that you want 8 hours free, it's going to go into your line haul rate. They may agree to it because you've standardized it, and that's fine. But it's going to go into your line haul rate. Your rates are going to be higher. It's going to degrade the trueness of a line haul rate. But it's also fair, so it's not discouraged. The key here, the founding principle of accessorials and fuel, is to make sure it's standardized. So all carriers see the same thing. What you don't want to do is adopt variables, because if you adopt variables, what you'll end up doing is skewing your spend data and the ability to analyze it properly in the future. So you want to be able to, again, extract some key components. And so bucketizing accessorials is important. So the two rules we have is make sure they're detailed, list them all out. If you have them, get them out there and get them identified and get a rate properly assigned to them. And then standardize them is the other thing to make sure that carriers know, all carriers know, that way you can weigh and measure the next time you run a bid, the true component of an accessorial. Is it 20% of your overall spend? Is it less than that? Is it mostly detention? Is it layover? Is it reconsignment? Is it stop off? Is it TO&U? You can ultimately drive down the deliverables of that for the next time you run a bid. And fuel is another big one. So there are 3 key components to a fuel surcharge. The first one is going to be the trigger. Fuel this year has gone crazy. It's gone up and down. I don't mean it's high. I just mean it's gone crazy. It went from being incredibly expensive to being free. and then back up to being reasonable and plummeted in the last 72 hours again. But ultimately, fuel is a variable cost, and it's the #1 cost driver for a trucking company. And because of that, you have to pay attention to your trigger. When does your fuel surcharge start? And so for the first $1.24 on this given example, it's incorporated in your line haul. It's okay, it happens, but the lower the fuel trigger, the truer the line haul rate's going to be. And then you have the steps. And this is a 5-cent step. I've seen 6, I've seen 7, and I've seen 10-cent steps. It's okay. All of them are okay. There's nothing bad or indifferent to any one of them, except for the fact that as long as they're consistent and all carriers are going off of it, you're going to be okay. And the bigger the step, the more impact the line haul has. So if you have a 5-cent step, then the line haul rate is going to be the truest it can be. The second you get to 6 or higher, you're going to start seeing that carriers are starting to pay, and it's going to depend on which way the market's going to. So if fuel is growing aggressively and their costs are growing aggressively, they want a lower step pattern. And if it's going down, right, and fuel is contracting, they want a higher step pattern. So it's a give and a play that you see there. But for the most part, fuel is flat or increasing. It doesn't spend a lot of time contracting. And when it does contract, it contracts aggressively. But the key is just pay attention to step patterns. The shorter the step pattern, the better off. And just make sure it's uniformed. And the next thing is the fuel surcharge and the rate per mile. Again, this is 1 cent on 5-cent steps. But you want to make sure that that increase is standardized. I've included thousands on this, which is fine. It's a pain in the butt for FP&A people, and it's a pain in the butt for ops people that are going to basically generate bill of ladings or tenders, because they need to drive down to the 100th or the 1000th, I should say. But you want to pay attention to the increase. And again, it's for back office at that point in time that you want to pay attention to it. But carriers care about this. And so it's important to make sure that in my opinion, it should be standardized, whether it's by you or by an intermediary that you hire. It should definitely be standardized. All right, the next thing that impacts rates is volume. And I will say this, at Redwood, in 2019 through 2020, we've done approximately 1,400 bids. And I can confidently tell you this, that every bid has annual volume listed in a single column. Not every bid, but most bids, greater than 90% of the bids. And when you put an annual volume of 200, people look at it and go, oh, okay, great, that's a high volume lane. And what we don't know is it 201 quarter and you're only a peak season shipper? Is it 200 and it is in the second half of the year? Is it in July and June when the market's volatile? Those are the things that when you look at annual volume, you want to basically drive down to the details. So quarterly volume is better than annual. It helps. And if it's evenly spread out, then carriers are going to infer that it's consistent and ultimately provide a more attractive rate. And if you get to monthly volume and spread it out over 12 months, it's going to garner an even more attractive rate because carriers are going to see consistency and find attractiveness to it. And then the last thing would ultimately be weekly volume. It's a hard ask. Most people don't have data to this level, or most people have huge supply chains and that would be a gigantic file. But the more information you can provide as it relates to the volume spread out over the year, the lower the rate's going to be. And it's funny, on the right-hand side, I have capacity and RPM going in the same arrows. I'm just going to talk to the points. It doesn't visually appeal, but ultimately, the better the weekly volume data is, the lower the RPM is going to be, but the higher the capacity is going to be. Carriers are going to ultimately know that they need consistently 3 trucks in a certain market for a given shipper, and they're going to provide those 3 trucks. They also are going to be able to see that, in the middle line, for month 6, they're going to see that, oh, hey, I need 30, so I need to start driving capacity in there. It's a busy week for them. This is very critical in regarding to how to running a bid, is to provide as much information as you can. We'll settle for annual volume, and carriers will settle for annual volume, but they'd love to see it spread out in order to basically come up with the truest rate. All right, moving on. So another thing that speaks to capacity is going to be, and rates is going to be lanes. And so you're going to single high volume lanes, you're going to have firm rates. And then volatility and lower capacity is going to come by when we have low density at an origin, low density, but one-off loads that are going to kind of a gypsy run that you don't know when it's going to happen. But the true middle is the biggest one, where you want to be able to leverage networks to be stronger. And so you want to look at a high volume lane and with 2 or 3 other ones where the truck may be able to aggregate or triangulate data to give you a better rate on not round trips, but basically better than round trips, which is kind of a 3-way move. Or a broker or a logistics service provider can ultimately pair your 2 lanes with one of their lanes. That middle one is important. We've got enough data and enough technology in this marketplace to understand that we're now in that space that's the most attractive for everybody and saving money. It's not about, hey, could I have 1,000 loads on one lane? That's easy. Or do I have 500 loads on a round trip? That's easy. And the rate disparity there is not going to be high. You should be able to procure on that very easily. But this middle area where we're matching stuff, that's where we're basically saving the most money for clients, or where you guys should be targeting. And then ultimately the capacity is going to come with it. All right, so we'll jump briefly into the process. I mentioned this earlier. It should take 12 weeks for you to run a bid. I think the only comment here is going to be, it is critical that in the 4 weeks of the distribution timeline and the distribution and the phase timeline, that you establish your round counts. And I'm going to say this: you need 2 rounds. 1 round bids ultimately don't usually hold water, and you get high rates, and it doesn't afford the ability to negotiate pair freight with lanes. And 3 rounds is overkill. 3 rounds ultimately, you're going to end up in a situation where carriers find things unattractive, change rates, withdraw themselves. You need 2 rounds, and 2 rounds is the right answer. As long as the second round is driven by analytics, where carriers know what they need to do, right? That's probably the most important thing, is to make sure during the second round, you provide feedback to the carrier to say, you are only off by this. There's value in that, and they will adjust rates accordingly. For the procurement approach, it's important to kind of carve out, first of all, if you're introducing an intermediary, you want to make sure that you have an LOA that you hold firm by. And if you're not, then you're basically hosting the bid yourself. You don't need an LOA. You need to begin just basically set your phases. But you spend 2 weeks basically building your freight profile and engaging carriers. You'll notice that weeks 3 and 4 are literally just getting the carriers to engage and get them data. And then once you ultimately get into the middle of the pack, you get to weeks 5 and 6, you start basically collecting carrier responses and driving some bid analytics. And then as you move on past that, you start walking into configuration of your routing guide, as well as round 2 and some negotiations. And then you finally want to pay attention to week 12, where you're going to go into a go live situation, which is critical because change management happens prior to that. So go live does not necessarily mean I'm going to give my plants the new day, here's a new carrier. You want to have that done in weeks 9 and 10, so that go live is as seamless as possible. And then everybody neglects this, and it's just my recommendation is go live is never flawless, and change management never ends. So you always want to make sure that you have carriers on the ready to adjust and based off of go live, whether that's your incumbent or your new carriers. Have a Rolodex that you can basically leverage to mitigate some risk as it relates to bid turnover. All right, so now you move on to the bid audience. And the bid audience is important. So this is a kind of 4 buckets that we put them in. You want to have strategic providers. Again, it can be brokers, 3PLs, logistics service providers, digital freight brokers, whatever you want to call them. You want to have a partner in this, in most of these bids, or multiple partners. But you want to make sure that you ultimately have somebody there because of what I talked about earlier. The market conditions are demanding help. And the demographics of the trucking industry are demanding help. And so you need to have intermediaries that can aggregate capacity, whether it's dark capacity, meaning that nobody knows where it is except for a few people that are integrated with them, or live capacity, which is basically a truck announcing its presence. Those are the things that you want to basically take leverage of when it comes to surge demand in a procurement event, and ultimately mitigating risk. There's national carriers. And again, your carrier, your freight profile is going to dictate who you are. So if you're a Southern California shipper during peak season only, and you have no consistency on the lanes, but you need drop equipment, you would definitely are a national carrier, or you need to move into a live load environment. And hedge your bets with a live load environment, but that's a national carrier. So again, your freight profile dictates what carrier community you need. And then your regional, again, if your freight stays within a region, we don't need national carriers. You need regional carriers. You almost need sometimes local carriers. And then you have niche carriers. And again, niche carriers come off of demographics. And so if you are based in Philadelphia, but have a DC in Oklahoma City, you need to know the niche carriers in Oklahoma City. And there's two ways to do that. Either find them, right? There's carrier lists, there's the internet, there is conferences. You want to find the carriers that serve that market. There's what we would call grandma knowledge, which is just things you know or inherent knowledge. So when you visit your facility, find the local trucking companies. Those are the niche carriers you're going to want to play with. And you're going to want to, that's a final mile, whatever it might be, but you want to basically be smart in the areas that you're shipping freight. But again, your freight profile dictates your carrier strategy. It's not the other way around. All right, so this is a critical slide right now to basically talk about rates. So once we've talked about our carrier strategy and what your freight dictates, right now is kind of that moment in time where it's important to understand that, again, right now is probably a great time to go to market because nobody knows where this is going. And it's clearly shown here. In the top left, you'll look at the contract van rates for contract van rates. And so for 2020, you'll see that we're at $1.94 in the month of August. You'll see that the kind of the tilt in the red line is pretty aggressive the last 2 months. That is just indicative, again, of the incredible demand that we've seen. And then on the right-hand side, you'll see the spot. And look at that red line on the spot. Look how aggressive that is from May to August. It's entirely of two things. The supply guys, the trucks, have not found their identity. They're still working on it. And then the demand did not dissipate. It actually accelerated past what we thought it was going to be. And that's clearly reflected in the bottom chart. We're only the second time in the last 10 years. In fact, if I drew this out in the last 30 years, it's only the second time in the last 30 years that spot rates are higher than contracted rates. So now is a good time to take good, qualified, identified freight to the marketplace because carriers are going to find value in it. You're going to find consistency. And again, you need to find that partnership. Just know that rates are going to be a little higher. But again, I caution everybody that it's not about the rates. Rates are the numbers and it's important. But the risk associated to not having rates right now is incredibly high. And the volatility of the marketplace is incredibly high. So right now, being informative and educated and going to the market is a good thing. All right, so we spoke about this, and so I'll move through these slides pretty quickly because we've got about 10 minutes left. But what goes into a contractual truckload rate? These are the things that I would look at if I was a shipper and I needed to pay attention to what I want to take to market. And so do I need assets? Do I need variability in my in the equipment itself? Meaning, can I load it at night? Is that beneficial for me? Is it not beneficial for me? Do I have a facility that's difficult to get into and out of? Those are the things that you want to look at in regards to, do I need assets direct? Meaning that I need to see, touch, and feel and understand what's happening. The next one is going to be drop equipment. It speaks to the asset story. The last one is going to be, is there consistency that can basically drive a network, whether it's my network or the carrier network? Is there round trip functionality? If we have round trip functionality or triangulation functionality, then you want to basically make sure you contract that freight. Your hours of operation, if they're 24/7, you probably want to contract some freight. If you're cyclical shipping patterns, meaning that you consistently ship, and most businesses see this, right? But they don't ebb and flow with volatility. They basically see a pattern in their freight network. Back to school's busy, end of year's this month, produce season's this month, whatever it might be. But if you see yourself in cyclical patterns, carriers can adopt to that. And so that's another thing that we want to contract. Incumbency is another one. So if ultimately you want to keep contracting your incumbents, but when you negotiate with an incumbent, whether you're using an intermediary or not, when you negotiate with incumbents, it's important to have leverage. And so that's the important thing that you want to have when you're dealing with a procurement event, is make sure that you have some carriers that can replicate what is being done. You may not use them, but it's important to just basically understand the leverage when it comes to incumbency. And then integrated. I don't know how to say this any differently. Visibility now is table stakes. And if we don't have it, you need to get it. And if you don't have it because you have basically a high carrier count or some variability in your freight mix, that's when you definitely want to leverage an intermediary, a logistics service provider. They can aggregate the data, but visibility is table stakes now, and everybody should have it. All right, what goes into a transactional truckload? These are, again, this is required. Every supply chain has this, and it's okay. I think that we need to take the panic off of transactional freight, because there are certain situations where live loads are okay. I mean, does it help you with dock labor, right? Where you, instead of having waiting or security, just live load them. There's a truck in the area. Can you live load them and take advantage of a lower rate? Do so. You don't need to contract that. You can contract that through an intermediary, but you don't need to contract it directly. I think you just need to have an intermediary that's looking out for you. It also provides some flexibility. Surge capacity is a big one. I can't emphasize this enough. Routing guides fail. They fail all the time. They are failing at a record rate right now. So having the risk mitigation strategy with transactional providers, that's what's saving a lot of companies right now. Is it one way, meaning that it's a one-time shipment and you don't care? That's a good transactional rate. A la carte service, meaning that you need team service, or you need basically somebody to lay over and do something goofy. It usually takes 10 hours to run, but you need to do it in 20. Contract providers aren't going to be interested in that. They've built a network around it. And so they're going to punish or not take the load if it doesn't fit what you guys had already agreed to. And then broker-owned capacity. I don't want to overlook this, is that brokers have networks that they've built, and you want to leverage those networks. They have 16, 18, 20,000 carriers in a Rolodex. You want to leverage those carriers in this market. It's a risk mitigation strategy. And then if in that case, for the table stakes, you just want to integrate with a broker. Visibility is required, and everybody knows that. So just make sure that we're connected with your broker. This is a big one, and probably where I'll spend most of my time in these last 6 minutes is going to be the routing guide structure. There was a time and a place for 10 carrier routing guides, or 5 carrier routing guides. And what ended up happening is the 4th and 5th carrier would wait and wait and wait and not get anything, and they'd build another network. They would no longer wait for your freight. So when your primary and secondary and tertiary carriers all said no, and you got to the 4th guy in line, well, he said no. Then you went to the 5th guy and he said no, and so on and so forth. And so the waterfall continuously broke. And because it continuously broke, you ended up getting in a situation where we didn't have a risk mitigation strategy in place. And now all of a sudden you're paying market rates for what might have been a high volume lane. And so it's important to kind of break it into 2 things: strong shipper resources and restricted shipper resources. Strong shipper resources, you're going to have a primary and a secondary carrier. On a contracted lane, that should be enough. With enough detail, as in the previous slides, a primary and a secondary carrier are going to build a network around it. You want a backup carrier, like I said, with somebody in the stable or pen, and you want to be sharing volumes with that backup carrier. It may not be to the full thing, but ultimately it's kind of a percentage where you want to, just depends on the volume. If there's 1,000 loads, this is easy, break it up. But if it's only 200 loads a year, you want to basically parse that out a little bit better to make sure that your backup carrier stays engaged with you and understands what to do. But 3 carriers is about it. After that, and one of the options you have is broadcast tender, right, with those 3 carriers. So you can basically say, I have 10 loads this week. The 3 of you have similar rates. Here we go. Everybody basically gets 3, broadcast tender. The first one to take them gets them. But there's a way you can tender to those 3, but that's where you want to stop. And then your risk mitigation strategy is bringing in a broker. Bring in a broker that has their own carrier community. Their rate may be a little bit higher because you're basically paying a transactional rate at that point in time, but it may not be. It may be a fixed rate that they've provided you in the bid for that given lane that affords you the ability to move that freight at a rate that's not at a market conditions. And on the right-hand side, you're going to have restricted shippers, which is basically my recommendation is that you'd have a primary and a secondary, and then ultimately a dual broker, two people looking out for you that have two carrier communities. You're going to basically pay attention to the primary and secondary relationships, and then leverage two brokers, because past that, you're going to end up in the high risk environment of transactional. And transactional, again, if it's not leveraged or protected by a couple of brokers, then you're going to be in the market and you're going to be buying market capacity. And again, on a day like this week or Friday of last week, we're in the middle of regulation or government inspections this week, and Labor Day and COVID. Transactional rates are 50, 60, 70% higher than they were last year. This is another reason why I recommend brokers and that waterfall strategy of 3 carriers or 2 carriers, depending on how many resources we have, is you want to pay attention to network capacity, which is demand capacity. A broker is going to be able to hold rates for a longer amount of time, but if you get to a same day environment, you're moving from network capacity, which is again a network that they've established on your behalf, and moving into market capacity with 24-hour notice, meaning that we're buying trucks that are available in a given market. And then if we wait for the same day, because the waterfalls break and the pricing from a routing guide or procurement event fail, if we're waiting for those things, you're now in a same day capacity. Now you're buying demand capacity, which is what we spoke about earlier. When it's 5 to 1 or 7 to 1, and you're the one truck, and I've got 7 loads, the winner there is rates. Nobody else, nothing else. The winner there is rates. And when it's rates driven like that, the rates go high, spends and supply chain get out of whack. And those are the things that over time add up and force new procurement events. I'm going to skip this slide. This ultimately was just the results of the customer slide that we had before. And what we did was we strategically looked at the carriers that they had on the left-hand side and introduced a portion of what Redwood had in their portfolio, and took a carrier mix that was ultimately 80-20. It moved to 57-43. And so we had, meaning that, and so for us, it was more about getting carriers that were committed to the business and spreading the wealth a little bit, not just 1, 2, or 3 guys at the top. You want to have leverage and some diversity, but also want to be careful with how you handle that as it relates to what you can and cannot take to the market as contract rate. This is important. I mean, I pointed it out earlier, is you don't want to lose sight of how you contract your carriers. So I recommend 1-year terms with your carriers. I also recommend, next slide I'll show you, I recommend frequency in bids. Don't be afraid to take your annual bid freight out more than once. Once is okay, right? But if you have a trouble lane or a trouble network with something changes, don't be afraid to launch another bid, which just goes to resources. You want to be careful with co-brokerage agreements. You definitely want to make sure there's risk, a lot of risk. If you're using a logistics service provider, make sure there's a co-brokerage agreement in there that they cannot do it, that they ultimately must be intermediary to the carrier. You can have specific addendums that carve out specific needs that your company may have. Pay attention to your insurance. Make sure the carriers are safe. Contract them. Establish visibility requirements. Establish OTP, OTD. You want to ultimately establish a bunch of stuff capacity, right? What are they committed to the lane? Are they overcommitted? Do they undercommit? But understand that when you're done and with your procurement event, you've established who your carriers are, you must contract them properly. And again, you can do it through intermediary, or you can do it directly. But if you do it directly, make sure that you have a contract for a carrier and a contract for a broker. Grade them. This is very important. At Redwood, we operate under the 9-box philosophy, but it doesn't necessarily is right for everybody. But make sure that you're grading your carriers and establishing KPIs, have the ability to change carriers that aren't performing. And then the last 2 slides, again, is going to be nothing is consistent, which is why I recommend an annual procurement event. Understand what your goals are. Find your carrier mix, get to the truest line haul rate, and then be ready for change. Be ready for something to basically destroy everything. All the hard work you put in for 12 weeks, be ready for it to change in 90 days. and be able to react to that. And so everything on a given day changes, and you need to be able to continue to adopt. And then the last point on my slide, I know I've gone over, but the last point is the last slide, is don't wait. Aggregate your data as quickly as you can. So we aggregate data at the tender level at Redwood. I recommend that you guys aggregate it at the tender level. Understand your ship patterns on the day that they happen so that you can aggregate, analyze, and then obviously adjust your routing guides accordingly. Don't wait for the procurement event to end to make changes to your network. With that, I know I've exceeded my time frame. I'd like to thank everybody for listening to me the last half hour on how to run a procurement event. And if you have any questions, please feel free to reach out to Redwood, and we'll be happy to follow up with any questions that are issued. Thank you very much. Have a great day.